In 2025, a 44-story office tower in downtown San Francisco sold for $6.5 million. The same building traded for $148 million just 6 years earlier. That is not a market correction. That is a 96% wipeout of value. And that building is not an exception. It is the rule. Right now, across the United States, the largest asset class in the history of human civilization is quietly repricing at levels that make the 2008 collapse look like a warm-up act. The difference between 2008 and what is happening today is that in 2008, the crisis was visible. People saw the foreclosure signs, they saw the news coverage, they panicked. What is happening in 2026 is invisible because the institutions holding the losses have every incentive in the world to keep you from seeing them. The banks are not panicking, they are waiting, the regulators are not acting, they are hoping, and the government is not warning you. It is managing your perception. This is not a conspiracy theory. It is the documented mathematical reality of extend and pretend, the accounting strategy that has transformed hundreds of American banks into walking financial corpses. Before we dismantle exactly how this mechanism works and what it means for your money, your home, and the broader economy, understand one thing clearly. This is not about fear. It is about incentives. And when you understand the incentives, the entire architecture of this hidden crash becomes obvious, inevitable, and measurable. The story begins not in 2026, but in 2010, in the aftermath of the last financial crisis. Regulators, terrified of triggering a second collapse, gave banks permission to carry impaired real estate loans at face value rather than market value. The logic was simple. If you force banks to mark their assets to market during a crash, the losses trigger insolvency. Insolvency triggers bank runs, and bank runs trigger depression. So they let the banks pretend. They let them carry a loan on a $200 million office building as if the building were still worth $200 million, even as the market screamed that it was worth $40 million. That regulatory flexibility was supposed to be temporary, a bridge over troubled water until the economy recovered and the values came back. The values came back, eventually, and for about a decade the strategy worked. Low interest rates made cheap debt available, remote work had not yet gutted office demand, and commercial real estate values floated upward on a tide of cheap capital. The banks gradually worked through the bad loans. Investors made money. The crisis was declared over. But something happened in that decade that planted the seeds of today's catastrophe. Every year of cheap money trained a generation of real estate developers, syndicators, and institutional investors to treat leverage as free. When debt costs 3%, you borrow as much as possible. You buy a building at a 4% cap rate with 3% debt, and the spread makes you money. The building appreciates, you refinance, and you pull cash out. You repeat the process until you have $1 billion portfolio built on a foundation of other people's money at rates that will never exist again. The Federal Reserve raised the federal funds rate by 525 basis points between March 2022 and July 2023, the fastest hiking cycle in 40 years. It did not raise them slowly. It did not give the market time to adjust. It moved with a speed and aggression that the debt-saturated commercial real estate market had never been designed to survive. Here is the mechanical reality that the mainstream financial press refuses to translate into plain language. A commercial real estate loan is not like a residential mortgage. It is not a 30-year fixed-rate instrument that locks in your payment for 3 decades. It is typically a 5 to 10-year loan with a balloon payment at maturity. This means the borrower does not slowly pay down the principal. They make interest payments for 5 or 7 years and then owe the entire principal balance at the end. In normal times, this is fine because the borrower simply refinances when the loan matures, rolling the balance into a new loan at current market rates. The entire model depends entirely on 2 assumptions. First, that the property generates enough income to service the new debt at whatever the new rate is. Second, that the property has appreciated enough in value to support the loan-to-value ratio required by the new lender. Both of those assumptions have simultaneously collapsed. The Federal Reserve's rate hikes destroyed the first assumption. A building that was cash flow positive with a 3% loan is deeply, structurally cash flow negative with a 7.5% loan. The income from the tenants has not doubled just because the cost of capital did. The remote work revolution destroyed the second assumption. Office vacancy rates in San Francisco have officially crossed 36%, according to CBRE research. In downtown Chicago, vacancy sits above 26%. In Washington, D.C., the figure is above 22%. These are not temporary fluctuations. They are permanent structural changes in how the American economy uses physical space. Major corporations, including Meta, Google, and Amazon, have collectively shed millions of square feet of leased space since 2022. They did not give it back because business was slow. They gave it back because they realized they do not need it anymore. When a building is 35% vacant, it cannot service the debt it was underwritten at 95% occupancy. The math is simple and devastating, and right now, $929 billion in commercial real estate loans are scheduled to mature in 2024 and 2025 alone, according to the Mortgage Bankers Association. Another $570 billion matures in 2026. This is the maturity wall, and the maturity wall does not care about your feelings, your hopes, or your extend and pretend strategies. It is a contractual cliff edge, and millions of borrowers are approaching it with no parachute. The banks know this, and here is where the incentive structure becomes critical to understand. A regional bank in the United States typically holds between 40 and 60% of its loan portfolio in commercial real estate. These are not the too-big-to-fail giants like JPMorgan or Bank of America. Those institutions have diversified globally and have access to the Federal Reserve's emergency lending facilities in a crisis. The institutions at risk are the 4,000-plus community and regional banks that form the actual backbone of lending for small businesses, local developers, and mid-market companies across the country. When a borrower cannot refinance because their building's value has collapsed, they have two options. They can inject fresh equity, meaning they bring millions of dollars of their own cash to reduce the loan balance to a level the bank will refinance. Or they can hand the keys to the bank and walk away. Blackstone, one of the most sophisticated real estate investment firms on the planet, chose to walk away from a $308 million loan on a San Francisco office complex in late 2023. They did not walk away because they ran out of money. They walked away because the math showed them that injecting more equity into a declining asset was economically irrational. If Blackstone, with its $1 trillion in assets under management and its army of PhDs, looked at a commercial office loan and decided the equity was worthless, what does that tell you about the thousands of smaller operators who made the same bets with far less analytical firepower? It tells you that the losses are real, they are enormous, and they are currently sitting on the balance sheets of regional banks marked at values that bear no relationship to reality. The Federal Reserve's own data confirms the exposure. According to the Fed's Financial Stability Report, commercial real estate loans represent approximately 28% of total assets at small banks compared to just 6% at large banks. The concentration risk is not distributed evenly across the system. It is concentrated precisely where the safety net is thinnest. The FDIC Insurance Fund, the pool of money that backstops your deposits if your bank fails, holds approximately $117 billion. Total insured deposits in the American banking system exceed $10 trillion. That ratio should give you pause. It is not that the FDIC cannot handle individual bank failures. It absolutely can and does, routinely and efficiently. The systemic risk is not one bank failing. It is the cascade. It is what happens when extend and pretend stops working for 50 banks simultaneously, in a credit environment where no one wants to buy distressed real estate. Because here is the feature of this crisis that makes it categorically different from 2008. In 2008, the problem asset was a mortgage-backed security, a piece of paper that could be traded, priced, and ultimately transferred to a new owner with a discount. The Federal Reserve could and did create facilities to absorb those securities. The problem asset in 2026 is a physical building, a 40-story glass tower sitting in downtown St. Louis or downtown San Francisco. You cannot print your way out of a 35% office vacancy rate. You cannot create a quantitative easing facility that puts tenants in empty buildings. The physical reality of the asset is the constraint that no monetary policy tool can overcome. The insurance crisis has quietly become the second front in this war on property values, and it is one that receives almost no serious analytical attention. State Farm, the largest property and casualty insurer in the United States, announced in May 2023 that it would stop writing new homeowner insurance policies in California. Allstate followed. Farmers followed. These were not small regional carriers exiting a difficult market. These were the largest insurance companies in the country, pulling out of the largest state in the country, covering the most valuable real estate market in the country. The official explanation cites catastrophic wildfire risk and rising reconstruction costs, but the financial mechanism is what matters for property owners. If you cannot obtain hazard insurance on a property, you cannot obtain a mortgage on that property. If you cannot obtain a mortgage, the only buyers are cash buyers. Cash buyers, when they are purchasing distressed or uninsurable assets, apply a distress discount. That discount is not 10 or 20%. It is often 40 to 60%. The moment insurance becomes unavailable in a market, property values in that market undergo a forced repricing to what cash buyers will pay. And cash buyers of troubled properties are predominantly institutional vulture funds whose entire business model is buying assets at a fraction of replacement cost. Florida presents an even more acute version of this dynamic. The average homeowner's insurance premium in Florida has risen by over 300% in 3 years, according to the Insurance Information Institute. In some coastal counties, premiums have exceeded $30,000 annually on properties where the mortgage payment itself is $24,000 annually. This is not a market distortion at the margins. This is the total destruction of the affordability calculus for home ownership in one of the most populated states in the country. When insurance costs more than your principal and interest payment, the true all-in cost of ownership has doubled overnight. That doubling is not captured in the official Consumer Price Index. It does not show up in the headline inflation numbers that the Federal Reserve targets. It is invisible to the monetary policy tools designed to manage it, which means the Federal Reserve is flying blind over the worst affordability crisis in American residential real estate history. The residential market appears stable. On the surface, the data supports this. The Case-Shiller National Home Price Index is not showing the 20 or 30% declines that some analysts predicted. Prices in many markets are flat or modestly positive on a nominal basis. But nominal prices are a lie when you apply the correct analytical framework. The correct framework is not price, it is transaction volume. Because a price that nobody is paying is not a real price, it is an asking price. Real estate economists at the National Association of Realtors confirmed that existing home sales in 2023 fell to their lowest level since 1995, the year 1995. That is a 28-year low in transaction volume, even as prices remained nominally stable. This combination, frozen volume and stable prices, has a technical name in credit analysis. It is called a liquidity trap, and it is the most dangerous condition a real estate market can be in because it means the price discovery mechanism has been broken. When nothing trades, no one knows what anything is worth. The sellers refuse to sell because they do not want to realize a loss. The buyers refuse to buy because the carrying costs at 7% mortgage rates are economically insane at current price levels. The market freezes, and frozen markets do not stay frozen forever. They eventually thaw. And when a frozen market thaws, it does not gently warm up. It breaks suddenly when one of the 4 economic triggers forces a transaction regardless of the seller's preference. Death, divorce, debt default, and job loss do not wait for interest rates to normalize. Life happens on its own timeline, and right now life is happening faster than the frozen market can absorb. Unemployment claims have been rising gradually throughout 2025. Mortgage delinquency rates on loans originated in 2022 and 2023, the vintages underwritten at peak prices with current rate assumptions, are showing early stress indicators that are statistically significant according to data from Black Knight, the mortgage analytics firm. The 90-day delinquency rate on FHA loans, the product most used by first-time buyers with limited down payments, has risen materially above its pre-pandemic baseline. These are not headline numbers yet. They are leading indicators. They are the early tremors before the main event. The shadow banking sector is the part of this story that keeps sophisticated credit analysts awake at night, and it is almost entirely absent from mainstream financial coverage. Shadow banks are non-bank lenders, private equity firms, debt funds, and insurance companies that have built a $63 trillion global lending infrastructure that operates entirely outside the regulatory framework designed after 2008. The bank reform legislation passed after the financial crisis, including Dodd-Frank, imposed strict capital requirements, stress testing, and leverage limits on regulated banks. The logical and entirely predictable response of capital was to migrate toward less regulated structures where those constraints did not apply. Private credit, meaning loans made by non-bank entities, has grown from roughly $400 billion in assets under management in 2010 to over $2 trillion globally by 2024, according to data from the Bank for International Settlements. This growth was fueled by the same cheap money environment that drove the commercial real estate boom. Institutional investors, pension funds, sovereign wealth funds, and endowments, desperate for yield in a zero-interest rate world, poured money into private credit funds that promised returns of 8 to 12% with low reported volatility. The low volatility was not real. It was a statistical artifact of the fact that private credit funds do not mark their assets to market daily the way mutual funds do. They value their loan portfolios on a quarterly basis, using internal models rather than market transactions. This process, known in the industry as mark-to-model, allows the fund manager to smooth out volatility by maintaining conservative assumptions about losses until those losses are so severe they can no longer be ignored. The technical term for this practice in the risk management literature is volatility laundering. The practical effect is that pension funds and endowments holding private credit allocations currently believe they are earning 10% annually on a low volatility portfolio. What they are actually holding is a collection of loans to companies that cannot service their debt in a 7% interest rate environment, valued at prices that have not yet been tested by a forced sale. The forced sale is coming. It is coming because the borrowers of this private credit, the small and mid-sized companies that took bridge loans and leveraged buyout financing at floating rates during the zero-rate era, are hitting their own maturity walls. S&P Global data shows that corporate bankruptcies in 2024 reached their highest level since 2010. The wave is building. Is Now, here is where the pieces connect in a way that should concern anyone who owns a home, holds a bank account, or participates in any pension or retirement fund. The regional banks hold the commercial real estate loans. The commercial real estate values are collapsing due to rising rates and structural vacancy. The banks cannot recognize the losses without triggering insolvency. They are playing extend and pretend. The shadow banks hold the corporate credit. The corporate borrowers are defaulting. The shadow banks cannot mark their portfolios to market without triggering investor withdrawals. They are playing their own version of extend and pretend. The residential real estate market is frozen in a liquidity trap with transaction volume at 28-year lows. The insurance market is withdrawing from entire states, destroying the mortgageability of millions of properties. The consumer is simultaneously experiencing the highest credit card interest rates since the 1980s, at an average of 22.8%, according to the Federal Reserve's own G19 data release, the highest auto loan delinquency rates since 2010, and the fastest drawdown of excess savings in the post-World War II dataset. These are not separate stories. They are one story. They are the simultaneous mechanical failure of every leverage point in an economy that has been running on debt for 15 years and has now encountered the unavoidable reality of higher for longer interest rates. The Federal Reserve has a problem that has no clean solution. If it cuts interest rates aggressively to relieve the pressure on the real estate market, it risks reigniting the inflation it spent 2 years and enormous political capital defeating. If it holds rates at current levels, it continues to bleed the commercial real estate market, the regional banking system, and the leveraged corporate sector simultaneously. The Fed's own internal research, published in working papers accessible through their website, acknowledges the tension between financial stability and price stability. What those academic working papers translate to in practical terms is this. The institution tasked with maintaining the stability of the American financial system is currently choosing between two different versions of a crisis: a deflationary banking crisis driven by real estate losses, or an inflationary crisis driven by premature monetary easing. They have not made this choice yet. They are watching the data. And the data is getting worse every quarter. The municipal finance dimension of this crisis is the thread that connects the real estate collapse to the everyday functioning of American cities, and it is a connection that almost no mainstream analysis has traced to its logical conclusion. Cities fund their operations through property tax revenue. Property tax revenue is calculated as a percentage of assessed property value. Assessed property value is supposed to track market value, with a lag of 1 to 3 years depending on the state and local assessment cycle. When the former AT&T building in St. Louis sells for $3.6 million after being assessed at $20 million, the city of St. Louis has a problem. The new owner immediately files for a property tax reassessment, which is their legal right under every state's tax code. The new assessment reflects the $3.6 million sale price. The city's tax revenue from that building drops by over 80% overnight. Multiply that dynamic by the hundreds of distressed commercial properties coming to market in every major American city over the next 24 months, and the fiscal math of municipal government becomes extraordinarily difficult. Chicago's Cook County assessor has already flagged significant commercial real estate value declines in the Loop District. New York City's Office of Management and Budget Projects' commercial real estate tax revenues will face headwinds for multiple fiscal years. San Francisco's budget office has explicitly cited commercial vacancy as a primary driver of its multi-hundred-million-dollar budget deficits. These are not worst-case scenario projections from fringe analysts. They are official government budget documents from the finance offices of 3 of the largest cities in the country. When city revenues fall, cities face a binary choice: cut services or raise taxes. Cutting services degrades the quality of life and business environment that justified the high real estate values in the first place. Raising taxes accelerates the flight of businesses and residents to lower-cost jurisdictions, which further erodes the tax base. This is the urban fiscal doom loop, and it moves slowly enough that most people do not recognize it until it is too late to exit without taking a loss. Detroit's population peaked in 1950 and the city filed for bankruptcy in 2013. That is a 63-year process of gradual decline that became a sudden crisis. The difference in 2026 is that the process is moving on an accelerated timeline because the interest rate shock is acute rather than gradual. The government will not tell you this is happening because its incentive is to manage your confidence, not your awareness. Confidence is a self-fulfilling prophecy in financial markets. If people believe their bank is solvent, they leave their deposits in place and the bank remains liquid. If people believe their bank is insolvent, they withdraw, and the bank becomes insolvent regardless of the actual quality of its loan book. This is the fundamental paradox of bank regulation. Transparency is necessary for market discipline to function, but transparency can trigger the very panic it is meant to prevent. Regulators have resolved this paradox in favor of opacity, which means the information available to the average depositor, homeowner, or pension beneficiary systematically understates the actual risk embedded in the system. The Federal Reserve's Senior Loan Officer Opinion Survey, published quarterly, shows that lending standards for commercial real estate loans have been tightening since the first quarter of 2022 without interruption. Tightening lending standards mean fewer loans, which means fewer transactions, which means lower prices, which means more impaired collateral on bank balance sheets, which causes further tightening of lending standards. The feedback loop is not theoretical. It is documented, measurable, and currently operational. The Office of Financial Research, a Treasury Department entity created specifically to monitor systemic financial risk, published a note in 2024 explicitly identifying commercial real estate concentration risk at small and mid-sized banks as a top-tier systemic concern. This is the government's own risk monitoring body flagging the same risk being described here. The information is public. It is simply not being translated into language that normal people can act on. The $7 trillion question, which is a reasonable estimate of the total impairment currently hidden across the commercial real estate, shadow credit, and residential sectors when adjusted for realistic market valuations, is who absorbs this loss. In a functioning market, losses are absorbed by the equity holders who took the risk. The developer who built the office tower at peak valuations loses their equity. The fund that lent the construction financing writes down the loan. The process is painful, the losses are real, but the clearing mechanism works. Capital is redistributed from imprudent risk-taking to more productive uses. The assets reprice to levels where new buyers can generate a return and new construction can eventually begin. This is how healthy markets process excess. The American financial system of 2026, however, is not a functioning free market. It is a system where the too big to fail designation has created a permanent implicit guarantee that the largest institutions will be rescued before equity holders realize their losses. This guarantee distorts every incentive in the system. It encourages large institutions to take concentrated risks, knowing the downside is socialized. It punishes the small saver and the middle-class homeowner who does not benefit from the implicit guarantee and must absorb the inflation that is the government's preferred method of making the math work without a politically toxic explicit bailout. The Federal Reserve's balance sheet expanded from $900 billion before 2008 to $4.5 trillion after the first quantitative easing cycle. It then expanded again to nearly $9 trillion after the pandemic response. Each expansion transferred the impaired assets of the financial sector onto the public balance sheet, while simultaneously diluting the purchasing power of every dollar held by every American worker and saver. The next expansion, which will be the response to the commercial real estate reckoning currently building in the regional banking system, will follow the same template, and like its predecessors, it will be announced with technical language designed to obscure the magnitude of the transfer from those who took the risk to those who did not. What happens to prices in this environment is the most consequential analytical question for anyone trying to preserve the value of their savings or the equity in their home. The answer is not simple because it depends on the sequencing of the crisis. In the deflationary phase, which is the phase the credit data suggests is beginning now, cash-generating assets decline in nominal terms as forced sellers hit the market in credit contracts. In the inflationary response phase, which follows the deflationary shock when the Federal Reserve and Treasury intervene with liquidity, the nominal prices of hard assets recover and exceed their previous levels while the purchasing power of cash savings is destroyed. The investor who understands both phases and sequences their positioning accordingly, holding liquidity during the deflationary phase and deploying it into hard assets during the inflationary response, generates wealth from a crisis that destroys the wealth of those who either held too many paper assets through the deflation or too much cash through the inflation. The timing of the transition between phases is the unknowable variable. No one, including the Federal Reserve, knows exactly when the extend and pretend strategy in the regional banking sector will break down into forced recognition of losses. It could be triggered by a single large bank failure that shatters confidence, a failed Treasury auction that forces emergency Fed intervention, or a slow, grinding deterioration of loan performance that eventually overwhelms the capital buffers of dozens of regional institutions simultaneously. What is knowable, because it is already in the data, is that the structural conditions for this transition are fully in place. The maturity wall for commercial real estate loans is not a projection. The loan documents are filed and searchable. The vacancy rates are measured and published quarterly. The insurance market withdrawal from coastal and fire-prone states is documented in state insurance commission filings. The consumer credit stress is in the Federal Reserve's own delinquency data. The shadow banking exposure is disclosed imperfectly but meaningfully in SEC filings and BIS quarterly reports. The pieces of this picture are all in the public record. The picture they form when assembled is one of a system that has been running on borrowed time and borrowed money and is approaching the moment when both run out simultaneously. That moment is the crash that the government will not announce, the banks will not acknowledge, and the financial media will not describe until it is already visible in the headlines. By the time it reaches the headlines, the window for protecting yourself has already closed. The institutions that manage the flow of capital in this economy have a structural information advantage. They see the loan performance data before it is published. They see the redemption requests before they are processed. They see the margin calls before they hit the market. That advantage is being used right now to position for the outcome that has been discussed in this analysis. The question is not whether the repricing is coming. The repricing is already happening, building by building, loan by loan, default by default, across thousands of transactions that are too small individually to generate a headline, but collectively represent the quiet beginning of the largest commercial real estate correction in American history. The question is whether you will understand what is happening clearly enough and early enough to be on the right side of it. The data does not lie. The incentives explain the silence. And the silence is telling you something that the headlines are not. Stay with this channel. The numbers will continue to surface. And when they do, you will already understand the structure behind them.